Hello, this is Andrew Hinrichs with Horizon Advisors. Today we will discuss hybrid insurance. Risk management and tax planning are two critical factors in a financial plan. Many of the clients that we work with are conservative, disciplined savers. You worked hard through your life and saved money as often as you could. You are now nearing retirement or maybe already enjoying it. You may have saved enough money that the likelihood of leaving a financial legacy is looking very probable. We believe one of the biggest risks standing in front of your goals being executed is an unprepared long-term care situation. With medical advancements, we are seeing people live longer and longer. This increases the odds of needing some long-term care in your lifetime. For some, it will be provided by family at home, all the way to 24/7 memory care in a nursing home. We have met people spending a couple thousand a month all the way to $14,000 to $15,000 a month, depending on the level of care and of the quality of the facility. Now, if you have one of these expenses, how are you going to cash flow it? Some will pay with their time, helping their family. Others will have to pay this expense out of pocket. You may have to use income from your sources of income. You might have to spend your investments. You might have to sell the house or use government programs. You can also invest money into a hybrid insurance policy. A hybrid insurance policy is a life insurance policy with a long-term care rider attached to it. We really like these types of policies of insurance because we know our clients are going to receive a benefit from them. It is certain that at one point you're either going to wake up an angel one day or you're going to need long-term care in some capacity. And we know that every dollar invested into the policy will eventually have some sort of rate of return to it. So let's say you looked at a $250,000 policy. Whether you pay 1 or 30 premiums, when you pass away, $250,000 will pass to the beneficiary tax-free. On the other hand, if you need long-term care, the policy will accelerate a certain percentage of that death benefit per month to pay for home care, assisted living, or nursing home expenses. So let's say that acceleration of the death benefit was 4% per month. That would be $10,000 a month you could use to pay for long-term care. If you were taking that maximum benefit, the policy would be used up after 25 months because you have spent the full $250,000. Purchasing a life insurance policy with a long-term care rider on it can secure that the long-term care coverage will be there without having a future premium increase. If you went into a long-term care situation and spent $100,000 and then pass away, the remaining $150,000 goes as a death benefit. So either way, you are putting a constant pool of money out there to pay for long-term care. If the stock market goes way down and you need long-term care, you have a fixed pool to access from that's not tied to the market. This helps reduce market timing risks out of the equation and help provide a stable cash flow. Even though hybrid policies are life insurance products, you may need a separate policy to fully cover death benefits needs in case the benefit on a hybrid policy is exhausted due to the long-term care expenses. Many of our clients also have most of their money in IRA accounts that they saved over their life. These accounts can be tax inefficient when passing down to the next generation. Life insurance has a tax-free benefit that pays out in a liquid cash to beneficiaries. You can take distributions from IRA and spread tax liability over time and reposition some funds into hybrid insurance as an option. This provides the tax-free benefit upon death or the need for long-term care. The final thing to consider is if this is a good use of money. So we can look at the rate of return report that shows different returns at different ages. Depending on what rating you received during the underwriting process, it could be a great investment if you look at it that way. Most investments have taxes and fees associated with them, which would make the insurance rate of return potentially larger. The hybrid insurance policy can accomplish multiple goals in an overall financial plan. We like the flexibility and consistency these can add to a plan. The cash flow of the policy adds to difficult life situations can certainly help as well. Thank you.